Whether you call it bread, cash, dough, loot, money really does matter.
It certainly does.
And it's often seen with suspicion, right? You hear root of all evil or the chains of labor.
Yeah, those old sayings.
But what if finance, the whole world built around money, is actually fundamental to human progress? And what if trying to get a handle on all of it just feels like, well, like drowning in data?
Oh, that feeling of being overwhelmed by information is absolutely real, especially with finance. It's so complex. It touches everything.
Exactly. So our mission today is to take this stack of source material, it's a deep dive into centuries of financial history, and pull out the really important nuggets.
Gonna boil it down.
Yeah, give you a shortcut,
Yeah.
help you get well informed on how finance has shaped, well, everything, really, and maybe uncover some surprising facts along the way.
We're looking at how financial systems evolved, the patterns you see again and again across time, across continents, and why knowing this history can shed some critical light on, our world today.
Okay, let's unpack this then. First off, what is money, really? We see coins, paper, numbers on a screen. Is that the whole story?
Well, the source material really pushes back on those purely negative views. It argues money is actually essential for progress.
Okay, how so?
The argument is that money isn't just a physical thing like metal or paper. Fundamentally, it's about trust. It's like trust inscribed.
Trust inscribed, I like that.
Yeah. Think about it. Anything can be money. Cowrie shells, giant stone discs like in ancient Yap,
Right.
or just electronic bits on a screen today. What gives it value is the shared belief, the trust that someone else will accept it later for something real.
So it's the belief. And at its core, what relationship does money kind of crystallize?
It's the lender and the borrower. The sources point out, interestingly, the word credit comes from the Latin credo.
Credo, I believe.
Exactly, I believe. It's literally the belief, the trust in the borrower's promise to pay back a debt. That mutual belief is the absolute bedrock. Without it, finance just doesn't work.
I love that connection credit is literally, I believe, it's about a promise. Okay, so we're talking trust and promises, not just shiny metal. Where do we see the earliest signs of this financial system starting?
You have to go way back. Ancient Mesopotamia, maybe 5,000 years ago.
Wow.
And what's truly fascinating here, the very first written records humans made. They weren't for history or poetry or great stories.
No. What were they for then?
Business. They were to do business.
Get out. Business came before epic poems.
That's what the evidence shows. We have these incredible clay tablets from places like Sippar. They record transactions, loans, repayments, usually in barley or silver.
Clay tablets.
Yeah, the lender kept them, often sealed, as the proof of debt and when it was due. Picking one up today, it gives you this feeling of awe, how deep these ideas go.
And this wasn't just simple IOUs, right? Babylon, under Hammurabi, apparently had some pretty sophisticated stuff going on.
Absolutely. The Babylonian system had things we'd recognize, like transferable debts, pay the bearer, basically. Yeah. They had clay receipts for deposits, kind of like early bank slips, and they definitely had interest on loans.
Where did interest come from?
Well, one theory is it might have come from watching livestock herds grow naturally. You lend animals, you expect more back, and there's even math exercises from Hammurabi's time suggesting they understood something like compound interest for longer loans.
Compound interest back then. That's impressive. But didn't Hammurabi's code also mention, like, wiping the slate clean sometimes? Debt forgiveness.
It did, yeah. Every 3 years or so. Probably to stop society from collapsing under debt burdens, prevent unrest.
Makes sense.
But even with those resets, people in temples kept lending and borrowing. They expected repayment based on, credibility. The system kept going.
It's such a contrast to the European conquistadors, right? Columbus and Hispaniola, Pizarro and Peru. They were just after the gold and silver, tons of it.
Yeah, seizing massive amounts. And what they fundamentally missed, the source argues, is that the value of gold or silver isn't absolute. It's not inherent wealth.
What do you mean?
If you just dump more gold into an economy, it doesn't automatically make everyone richer. It just makes prices for everything else go up. Inflation.
Ah, right.
Money's only worth what someone else will give you for it. Focusing just on hoarding the metal, that was a basic misunderstanding of how finance and wealth actually work.
Okay, let's jump forward. Medieval Europe. Big changes happening, partly math, partly religion. Fibonacci is a key name here.
Yes, Leonardo of Pisa, Fibonacci. His book, Liber Abaci 1202, was just revolutionary for European business. He brought the Indian method to Europe.
The Indian method.
The numbers we use today, Hindu-Arabic numerals, 0, the decimal system.
Which seems so basic now, but imagine trying to do, I don't know, calculate interest or profits with Roman numerals. MCML XXE on X times 14, forget it.
Exactly. It made commercial math practical vastly easier. People know him for the Fibonacci sequence, sure, but the real impact for finance was the practical stuff. Calculating interest, profits, even the idea of present value, figuring out what future money is worth today, super important.
And yet, alongside this math revolution, you had this huge religious roadblock in Europe.
Right.
The ban on usury, lending money at interest, was a major sin for Christians.
Oh, it was a massive issue. The Third Lateran Council in 1179 basically excommunicated usurers. Later councils even said arguing against the ban was heresy.
Heresy? Wow.
Yeah. Christian usurers faced really harsh social penalties, couldn't even get buried in consecrated ground sometimes.
Yeah.
Orders like the Franciscans and Dominicans absolutely hated them.
So if Christians couldn't really lend at interest, who did? Because merchants needed credit, right? The economy was growing.
Well, this is where minority groups, especially Jewish moneylenders, played this really crucial and often dangerous role. They weren't bound by the church's rules in the same way. So merchants in Venice, for example, they had to go to the Jewish getter to borrow. They did business literally from benches or tables, banchi and taliasili.
Boinchi.
That's exactly where we get the word bank. And table in finance.
Huh? Suddenly, Shakespeare's Shylock makes a lot more sense. Okay, so out of this mix, merchant needs, religious rules, you start seeing powerful financial players emerge, like the Medici in Florence.
The Medici are a classic example. They started out, frankly, more like political fixers, maybe even gangsters.
Really? Gangsters?
Well, before Giovanni de' Medici decided to make them legitimate bankers, he started managing the Pope's money in Rome, dealing with all the complex currency, trading lots of different coins, often debased. Then he went back to Florence, expanded, set up branches in Venice, Rome. They were pioneers in double-entry bookkeeping, too.
And around this time, we also start seeing the first bond markets.
Yeah, Italian city-states needed money for war, so they started selling debt. But it also popped up in Northern Europe. Towns like Douai, Calais, Ghent sold these perpetual annuities called rentes heritables or erfelijkrenten.
Perpetual annuities.
Basically, you paid the town a lump sum, and they promised to pay you or your heirs a fixed amount every year forever. The genius part was structuring it as buying an income stream, not just a loan. That got around the church's ban on interest for a simple loan, a mutuum.
So trying to get around the usury rules actually sparked financial innovation.
Clever.
Okay, moving on from medieval times. The next huge leap seems to be the company itself, but in a new form.
Oh, absolutely. The joint stock, limited liability corporation, that was a true game changer for everything finance, global trade.
Why was it so important?
It let thousands of people pool huge amounts of money for really big, risky, long-term projects. Think trading voyages across continents, stuff individuals or small partnerships just couldn't afford.
Yeah.
And limited liability was a magic ingredient. Your personal wealth was safe if the company failed. You only risked the money you actually invested, your stake. That encouraged investment in risky ventures.
Makes sense. But whenever you get lots of money chasing big speculative ideas, you often get bubbles, right? The source talks about a classic cycle.
It's a pattern you see over and over. It starts with displacement, some new invention, new market, new opportunity gets people excited.
Okay.
That leads to euphoria. Prices for assets tied to this new thing start rising fast. People imagine huge profits.
Then
Mania, the bubble phase. Everyone piles in, first-time investors, speculators, sometimes outright scammers. Prices go crazy, totally detached from reality.
Uh-oh.
Next comes distress. Smart money starts selling. People realize that the prices are insane. And finally, revulsion or discredit.
Right.
Everyone panics, rushes to sell, the bubble bursts, prices collapse, crash.
And one of the earliest, biggest examples linked to one of these new corporations was the Dutch East India Company, the VOC.
Founded in 1602. Yeah, widely seen as the first modern corporation. It had tradable stock, which was new.
Right.
Interestingly, it had problems right away. Directors appointed for life, total secrecy. Shareholders actually fought back.
You did. Back then.
Yeah, shareholder activism. They demanded term limits for directors, oversight committees, these 9-men auditors, even standard dividend payouts. So fights over corporate governance. They're centuries old.
That's fascinating. Early investor activism. But the craziest bubble story, the one that sounds almost like a comedy, has got to be John Law and the Mississippi Company in France.
Oh, John Law's system. Yeah, that was
Yeah.
extraordinary. And a huge warning about linking money printing to asset bubbles. This was 1719, 1720. Law basically ran France's central bank, the Banque Royale,
Okay.
and he controlled the Mississippi Company, which had a monopoly on trade with France's huge chunk of North America, Louisiana, which was mostly wilderness, by the way.
Right. So how did he link the bank and the company?
He tied the issue of the national currency directly to the company's share price.
Wait, what? How does that even work? That sounds circular.
It absolutely was. The company bought up other businesses, like France's tax collection rights, not with profits, but just by printing more shares.
Yeah.
Law himself owned tons of stock, so he got rich as the bubble inflated.
Which his own bank was fueling.
Exactly. He kept issuing more stock. People called them daughters and granddaughters shares. And crucially, his Banque Royale lent people money using their Mississippi shares as collateral.
So they could use that money to buy
Yeah.
more shares.
Precisely, which drove the price from maybe 550 livres to over 10,000 in less than a year. Pure mania.
Unbelievable.
He even paid dividends with paper money printed by his bank. The whole grand vision of Louisiana generating massive wealth. Total fantasy. Most colonists died. The promised riches never appeared. The paper pyramid just collapsed spectacularly.
What a mess. But like you said, not the only bubble. We saw the South Sea bubble in Britain around the same time, the dot-com bubble more recently.
Financial history is absolutely full of them. It's just part of the process, it seems. But it is worth noting, despite the crashes over the long haul, stocks have done well. Like the S&P 500 between 64 and 2007 way outperformed bonds and bills, even after the dot-com bust.
So volatility is part of it, but maybe long-term growth too. Okay, booms and busts.
Mm.
But what about the basic risks of just being alive? Storms, getting sick, getting old, losing your job.
Yeah.
That brings us to insurance, right?
Yeah, life's always had dangers. But the thing is, many aren't purely random when you look at large groups. We can estimate probabilities.
Like for hurricanes.
Exactly. We have data going back to the 1850s. We can figure out the likelihood of storms of different sizes happening over time. Though predicting one specific massive event like Katrina, well, that gets tricky. That blurs the line between risk we can calculate and just pure uncertainty for any one person.
And so insurance developed out of this need to manage and pool those kinds of risks.
Yes, often triggered by big disasters that showed everyone how vulnerable they were alone. After huge fires in New York in 1835 and Hamburg in 1842, governments started making insurance companies hold reserves to make sure they could actually pay claims.
Regulations kicking in?
Right. And that also led to reinsurance, where insurance companies insure each other for the really massive risks. Lloyd's of London started informally, underwriters sharing risk voyage by voyage, initially with unlimited personal liability.
Ouch. Unlimited liability.
Yeah. Until companies like Sun, Royal Exchange, London Assurance brought limited liability to the insurance game.
And this whole insurance business relies pretty heavily on math, I assume.
Oh, absolutely. At the heart of it, you've got ideas like Bernoulli's law of large numbers from way back in 1705. Basically, the more times something happens, the closer the average result gets to the statistical probability. Crucial for insurers predicting claims across lots of people.
Okay.
And later, Domrov's work on the normal distribution, the bell curve, helped them predict not just if things happen, but how big the financial hit is likely to be for a population.
But Katrina, that disaster really showed some cracks in the modern insurance system, didn't it? Big controversies.
It certainly did, especially those fights over wind versus flood damage. Was it covered by homeowners insurance or not? Huge
Right.
issue.
Okay.
And the case with the lawyer Dickie Scruggs brought a ton of attention to claims that insurers were trying to dodge payments, even changing engineer reports. State Farm did settle a lot and reviewed claims, but Scruggs himself ended up jailed on unrelated bribery charges later. A whole saga.
Yeah, messy. Okay, beyond private insurance, the source material talks about something much bigger as a kind of social insurance. The welfare state.
That's an interesting way to frame it, yeah. The welfare state can be seen as this collective system society sets up to provide security against life's big risks: sickness, unemployment, old age, disability, trying to guarantee a minimum standard of living.
So society pooling resources to manage individual risks.
Kind of like a giant insurance policy for everyone.
Japan's experience is interesting here. Their welfare state developed differently.
Yeah, it wasn't just a post-WWII thing. It actually has roots in the 1930s. The source calls it a warfare welfare state.
Or fair welfare.
Initially, the military wanted healthier recruits, so they expanded health and pension coverage during the war, using slogans like, "All people should have insurance" to boost national strength. They resisted some post-war Allied suggestions and built their own system, seeing it in national terms, expanding it in the 60s when welfare spending overtook defense.
But welfare states aren't without problems, right? There are critiques, debates about incentives, and the huge challenge of aging population.
Exactly. Look at the UK big welfare expansion post-war, but also periods of low growth, inflation. Contrast that with Chile's move to a private pension system in the 80s. That channeled savings into investment, got high returns for people. A different model.
And the aging population problem.
It puts huge pressure on pay-as-you-go systems,
Yeah.
where today's workers pay for today's retirees. Fewer workers supporting more retirees. The math gets tough.
Okay, so managing risk is ancient, but it gets incredibly complex today, especially with financial derivatives.
Yeah, the basics are simple. Think of a farmer using a futures contract to lock in a price for their wheat before harvest. That's hedging.
Protecting against prices falling.
Right. But financial derivatives take that idea and run with it, applying it to all sorts of financial assets.
So how do they work? Exactly, what are they?
Their value is derived from something else, an underlying asset. Could be a stock, a bond, oil price, interest rates, even the weather, like you mentioned.
Okay.
You have futures, contracts to buy or sell something at a set date and price in the future. Options give you the right, not the obligation, to buy a call or sell a put at a certain price by a certain date. And swaps, agreements to exchange cash flows, maybe based on different interest rates or the risk of a company defaulting. They let you slice and dice risk in really complex ways.
And some are really out there, like those weather derivatives
Yeah.
or cat bonds, catastrophe bonds.
Those are fascinating modern examples. If your company gets hammered by, say, a massive hurricane, you might have bought protection through a cat bond. You sell the tail risk, the risk of a rare, huge disaster to investors like hedge funds.
Why would they buy that risk?
They get paid an attractive interest rate for taking it on. If the disaster doesn't happen, they collect the interest and get their money back. If it does happen, their investment pays out to cover the losses. It's transferring risk that used to be basically uninsurable.
Which brings us to quantitative finance.
Hmm.
Quants. Using super complex math and computers.
Yeah, funds like Citadel, Renaissance Technologies, they hire physicists, mathematicians, computer scientists to build these incredibly complex trading algorithms. They use portfolio theory, trying to find uncorrelated bets, building on work by guys like Markovits and Sharp.
Uncorrelated, meaning when one thing goes down, the other goes up, or at least doesn't move with it.
That's the idea, diversification. But as we saw in crises, sometimes things you thought were uncorrelated suddenly all move together in a panic. Models based on history can break down spectacularly.
And maybe the biggest recent example of all this complexity, risk, and models breaking down was the 2007-2008 housing crisis.
Oh, absolutely. That shook the entire global financial system to its core. It started in the housing market, obviously, especially this big post-war push for the property-owning democracy in places like the US and UK.
Where most people own their homes.
Right. It became this huge economic and political goal.
Yeah.
And the US housing boom in the early 2000s was just massive. Like half of US GDP growth in early 2005 came from housing.
It felt like house prices could only go up, but mortgages in the U.S. weren't always like that, were they? So easy to get.
Not at all. Before the Great Depression in the 30s, mortgages were often short-term, interest-only, with a big balloon payment at the end. Very risky for borrowers.
Which caused huge problems in the Depression, I imagine.
Mass foreclosures. Home ownership was much lower back then, too, maybe 40%.
And this connects to deeper social issues, like the history the source mentions in Detroit.
Detroit is a really stark example in the source. It shows how finance, social policy, race, and inequality all intersect. You had deep class conflict, racial divides, and practices like redlining, where black neighborhoods were just written off as bad credit risks.
So they couldn't get mortgages easily.
Exactly. The source connects this history, the tensions in places like the Ford plant shown in those Rivera murals, to events like the 1967 riots, seeing them not just as violence, but as a rejection of a system that excluded black citizens from that dream of homeownership.
So after the Civil Rights era, Policies changed to try and fix that, broaden access.
Yeah, there were real efforts. Splitting Fannie Mae, creating Ginnie Mae and Freddie Mac, anti-redlining laws, the Community Reinvestment Act in '77 pressuring banks to lend in underserved areas. The explicit goal was wider access to homeownership.
But that same era, the 80s, also had the savings and loan crisis. More financial trouble.
The S&Ls got hammered. They were traditional mortgage lenders, stuck holding old, low-rate mortgages while inflation and interest rates soared in the late '70s, early '80s. Their funding costs went through the roof as depositors chased higher rates elsewhere.
They were losing money just sitting there.
Pretty much. Deregulation meant to save them actually opened the door to fraud, risky insider deals. Remember the I-30 condos scandal? Eventually, their federal insurer, the FSLIC, went bust, a huge bailout.
And you're saying the S&L crisis cleanup actually paved the way for 2008 through securitization?
In large part, yes. Dealing with all those bad S&L loans, plus lenders wanting to get mortgages off their books faster, led to this massive boom in bundling loans and selling them as securities.
Okay.
And that included subprime mortgages loans to people with shaky credit. They got packaged into these complex things called collateralized debt obligations, CDOs, and somehow, through financial alchemy, as some called it.
Alchemy. Turning lead into gold.
Kind of. Rating agencies stamped large parts of these CDOs with AAA ratings, made them look super safe.
Even though they were full of risky loans.
That was the core problem.
Yeah.
And the crucial failure was risk allocation. The people originating the loans, who maybe knew how weak they were, sold them off immediately. They had no skin in the game.
So who held the risk?
It got sliced up, hidden in complexity, and sold all over the world. German regional banks, Norwegian towns, buyers who often had the least understanding of what was actually inside these packages.
And that's how defaults by homeowners in, say, Cleveland or Phoenix could trigger a global meltdown.
Exactly. When those borrowers started defaulting, the supposed safety of the CDOs evaporated. Fear spread like wildfire. Nobody knew who was holding the bad debt or how much. Counterparty risk soared the fear that the bank or institution you dealt with might collapse.
So banks stopped trusting each other.
Right. Critical short-term lending markets like commercial paper or interbank loans just froze because banks had hidden a lot of this exposure off their main balance sheets in these weird entities, conduits, SIVs, structured investment vehicles. Anyway, when firms like American Home Mortgage went bankrupt, or BNP Paribas froze funds linked to this stuff, or Countrywide needed emergency credit, panic set in. The Fed and other central banks had to flood the system with liquidity after Bear Stearns, Merrill Lynch teetered, all traced back to those bundled mortgages.
It's staggering. And this brings us to the bigger picture, these global cycles of boom and bust. Seems like a recurring nightmare.
It really does feel that way sometimes. Emerging markets, for example, they've been through this ringer many times before.
Yeah.
Latin America in the 1820s, bearing bank crises in the 19th century, Latin America again in the 80s, Asia in the 90s.
So maybe your emerging markets is a better term.
Probably, yeah. They've seen this movie before.
China's a huge player now. How did they navigate the 2008 crisis relatively well? Their history with foreign money wasn't always smooth either.
No, definitely not. Think Opium Wars, Taiping Rebellion. Foreign investors lost fortunes in China historically, but recently they managed things differently. Key policies helped. A big devaluation in '94 made them competitive. They kept capital controls to limit speculative money flows.
Limiting hot money.
Right. They pushed for direct investment factories, infrastructure, not just borrowing foreign cash. And crucially, they funded their growth mostly through sky-high domestic savings, unlike the debt-fueled West.
The source also suggests that globalization itself isn't always a one-way street. It can be fragile. Like before World War I, things looked pretty good then.
Incredibly optimistic, global bond risk was falling, money flowed easily across borders. Some thinkers, like Bloch and Angel, even argued war was becoming economically impossible because nations were too interconnected financially.
Oops.
Big oops. WWI just shattered that illusion. Stock markets shut down for months, massive losses, inflation, hyperinflation. The pre-war world of free capital movement, gone. Couldn't be put back together the same way.
Which led to a period of deglobalization between the wars.
Exactly. You saw currency crises, defaults, countries throwing up trade barriers, capital controls, exchange controls, everyone trying to protect their own finances, often hurting global trade and cooperation.
After WWII, Bretton Woods was the attempt to rebuild a stable system.
Yeah, efforts like the Marshall Plan helped Europe, but aid to the developing world often fell short. And investors still showed home bias, mostly investing domestically. The system relied heavily on the US dollar linked to gold until Nixon ended that in '71 due to various pressures.
And then you get things like the LTCM collapse in the late 90s. Even the smartest guys in the room, Nobel winners, running these complex quant strategies.
LTCM is a classic case. Their models assumed different market risks were uncorrelated. But in the crisis triggered by Russia defaulting, suddenly everything moved together in panic. Their models blew up, huge losses, and the Fed had to organize a bailout because LTCM was so big, its failure threatened the whole system.
Systemic risk.
Exactly. And yet, despite LTCM's spectacular failure, the hedge fund industry itself has grown massively since then. The hunt for high returns via complex strategies continues, despite the known dangers.
So looking back at this whole sweeping history,
Right.
clay tablets to derivatives,
Yeah.
what are the big lessons? It's definitely not a straight line of progress, is it?
Far from it. The source argues against the old idea that finance just inevitably concentrates into bigger and bigger monopolies. It's more like
Whoa.
evolution.
Evolution.
Yeah. Financial history is full of speciation, new kinds of firms, new instruments appearing, and creative destruction, weak firms getting wiped out, especially in crises. Being big doesn't guarantee survival. Adaptation and returns matter more.
And regulations, like rules about how much capital banks need to hold, they don't always work perfectly because of the bank's own incentives.
Right. There's always this tension. Regulators want safety, so they impose rules like the Basel capital requirements, but banks want to maximize profit, which often means minimizing the capital they hold and using more leverage. It's a constant push and pull.
So it really is a roller coaster, like you said. Bubbles, busts, manias, panics. They just keep happening.
Undeniably, studies show there's a pretty significant chance of a major financial crisis hitting GDP or consumption in any given year, looking back over 150 years. Crises aren't weird exceptions, they're baked into the system, it seems.
And even with all our fancy models and tools today,
Right.
are we still fundamentally vulnerable?
That's maybe the most sobering takeaway from this whole history.
Yeah.
Despite everything, yeah, the system is still vulnerable. We can still get fooled by randomness, as Taylor would say. Think we understand risks, but we don't.
Still get surprised by black swans.
Exactly. Those unpredictable, massive events nobody saw coming. The source even floats the possibility of a super bubble involving multiple asset classes globally. History suggests it's not impossible.
And it's not just the math and structures, right? Human psychology plays a huge role in all this.
Oh, absolutely. Behavioral finance is key. Our biases, confirmation bias, only seeing what we want to see, anchoring on prices, letting fear or greed drive decisions, they fuel the manias and the panics. Finance is deeply, deeply human.
So what a journey. Ancient trust on clay tablets, medieval money lending taboos, sparking innovation, the rise of corporations in these wild bubbles, insurance and welfare states trying to manage risk, and now complex derivatives and global crises.
It's a huge, messy, fascinating story, and understanding it really matters for you, the listener. I mean, your savings, your house, the job market, the stability of the economy you rely on, it's all connected to these forces, these historical patterns.
Seeing these cycles, the risks, the human element, the constant tension between innovation and stability,
Right.
it gives you a much sharper lens, doesn't it? For looking at the financial world today, it's not just numbers on a screen, it's history, trust, psychology.
So maybe the final thought to leave you with is this. Given these endless cycles of boom and bust, and the warning that even now we can be fooled by randomness and hit by black swans, what does this deep dive really tell us about the true nature of financial security? Is it something we can ever fully grasp or guarantee in our modern world?